Hi, my name is George Dagnino. I'm the editor of the Peter Dack Portfolio. I spend roughly 2 to 3 hours every evening to watch on YouTube the various podcasts or what various economists, analysts, stock market traders are saying, just to get an idea what is the general opinion of what people think the markets or the economy is going to do. And if you do the same thing, you come up with very strong belief that no one really knows what they're saying. There is some people saying, man, there's going to be a recession. And very famous people are saying that now for roughly 2 years. And they're being interviewed on all podcasts with terrible outlooks. The world is going to collapse, the dollar is going to collapse, interest rates are going to go to 100% and everything else. Then there is another group instead is saying, cool off, take your time, let's make sure you understand what's going on. And it looks like things are not as bad as the data, some data seem to show. Now, why the two different opinions? Because this set of people focuses on the bearish data. Okay, so they look at the data that point down, and they say, okay, you see, now this is why I'm going to be right, and of course they've been wrong. The other people are saying, well, there is another set of data that instead says things are really not that bad. So what is really going on? This is the purpose of this video, is to look at both sets of data, put it in a business cycle context, and see what are we going to do with it. Should I invest my money? This is really the bottom line. So what the problem is that from a business cycle viewpoint, in phase one is when business start picking up. Okay. And phase two, of course, strong growth, and there is inflation, interest rates start rising. Phase three, the economy slows down because inflation is reducing demand, business cuts down. And in phase four is where you have the correction. The correction means interest rates are going to come down, commodities are going to come down, inflation is going to decline, and also the equity market is coming down. That's the important thing. All prices come down in phase four. Then once the excesses that have been created in phase one and two are brought under control, then phase one again, consumers see interest rates much lower, so they can afford more, they start buying, and the system goes on. So what I want to do now is to see what the people are saying is they're looking at this data here and they say we are in a recession. But the other people say no, some data are saying that we are in phase one, the economy is expanding. So they're both right. But the point is, how do you make money out of this thing? Because really the stock market is saying we are in phase one. So what I want to do, again, looking at the data, the two sets of data, and see why things are happening the way they are. This is the most important set of information that people ignore. And it's as surprising as it can be. But the fact is that income, which is the blue line, and the red line is consumer spending, is growing around 2-3%. And that is a fact. It doesn't matter what the reasons are, but the fact is, obviously, the main reason is a huge government spending and programs. But the fact is that income and consumer spending are growing. In real terms, this is after inflation. So you can talk recession all you want, but as long as income and spending are growing, there is no recession. This says that the economy is in phase one. But let's look at the rest of the story. This is an interesting piece of data that I found, which is unbelievably resembles our proprietary business cycle indicator. It's an unbelievable series, and is the producer prices of corrugated fiber boxes. In other words, if you want to ship anything, you have to have corrugated boxes, right? So the fact that prices are going up, remember the materials are very sensitive to demand. That's the other thing that from a business cycle viewpoint. So this prices have been expanding, and every time you see going prices rising, slow down, up, down, every time there is a acceleration and deceleration in the economy, it matches exactly our business cycle indicator. So what has been saying is 2022, the economy has been slowing down, and the market, of course, took a beating, the stock market. But then now, beginning 2023-24, has been going up, peaking up, meaning what? That things are not bad. Actually, they're pretty good. Somehow there are goods being produced and goods being shipped. So this is supports the idea that income and spending, people spend and goods are shipped in corrugated boxes. Again, here, remember, don't forget, I'm trying to build the positive case. Then I'm going to go to the other set of data. This is another, the New York Fed and the Atlanta Fed, a very sophisticated model of the economy, which every time there is a new piece of information that comes out, they put it in their models and say, okay, it's not a forecast, it's what is the economy doing now, okay? And what they're saying, the New York Fed is saying the economy is growing at 3%. This is strong growth after inflation. This is very strong growth. The Atlanta Fed is roughly 2.5%, almost the same number. So what these models are saying is, yes, they support the idea that income is growing, goods are being produced, they're being shipped, and the economy is growing. But there is more good news for the bulls. Not only the economy is expanding at a fairly strong pace, but inflation is also coming down. And the dark line I follow closely, this dark line, because it's home prices. And as you can see, home prices, the growth in home prices leads overall inflation. These are producer prices, these two lines here, and then you have consumer prices and the personal consumption expenditures price index, the light line, that are also coming down, which is now roughly 2.2%. And as you can see, the trend is clearly down. There is no question about it. So not only now you have a fairly strong economy, which the bulls are saying, but you also have lower inflation. So this increases the purchasing power of consumers, which further improves the acquisition of goods. But the good news is not over, because now it's true, this is the graph of the money supply, how much money there is in circulation. When the money supply slows down, like in this case, you have an economy that slows down, and also you have inflation that declines. But look what has happened since 2022. The money supply has improved, and as you can see here, actually is growing at more than 2%. And it keeps on going. Not only that, but the money supply is the main item in the money supply is deposits. Deposit means how much deposit in large commercial banks. What that means is that banks are lending, and in fact they're lowering in lending standards. So they have so much money that they want to lend. When they lend money, the person that borrow money puts the money back into another bank, and that's what deposits are increasing. Then the new bank receives these deposits and relend them. So that's what makes the money supply grow, which means the economy is not that bad when you have that kind of progress. When you have to worry is when this happens, not when this happens. So, and this further confirms the bullish case that says not only the economy is strong, but is supported by an increasing liquidity. Yes, there is a lot of liquidity. And in fact, if you look at bond spreads, and this is what this curve show, This is the high yield bond spreads, and this is the higher grade uh, bond yields. The spreads between bonds and treasuries is coming down quite sharply and is very low. It's closer to historical lows. What does it mean? That there is no risk in the financial system. The financial system has plenty of liquidity. Inflation is coming down. The economy is growing, and there is little risk in lending money to corporations. That's why the spreads are so low, confirming that there is, again, liquidity in the system. So this is the bullish case about the economy. And quite frankly, I feel it's quite strong. All the data I showed you before, all the trends, they say we are in phase one. In other words, the economy is picking up, is growing, everything is fine. Now let's look at the other side of the coin. That is, what is going wrong in the economy, and then let's try to balance out the two views. Now this is a chart, the graphs of durable goods orders. The durable goods are big ticket items, plants, machinery, equipment, that kind of stuff. And also from a consumer, they also show the consumer spending on durable goods. That is, consumer spending on big ticket items, refrigerators, cars, big stuff, more than $3,000. What does it show? Well, it shows that consumers are not buying big ticket items since 2022. In other words, the story here is consumers are tapped out. In other words, they like to buy, go on vacations, go on a cruise, go to the restaurant, but when it's time to buy a big expenditure, they're not doing it. They're not spending. It's been contracting for the last couple of years. So this is bad because we means that manufacturing is not cannot produce, and if manufacturing is weak, and in fact is very weak, manifest being contraction since 2022, you cannot have a strong economy, and this is a very negative impact on manufacturing. This is a shipments, the Cass Freight Index shipments, and it shows what the industry is doing. And what you see is really not good news. From 2022, you see it's been coming down, which is consistent with the previous chart. In other words, the transportation industry is in a recession. They have tremendous problems, and they're not shipping. Why? Because manufacturing is not producing, and this is where really the high-paying jobs are. This is where the backbone of the economy is manufacturing, and manufacturing is in deep trouble, and the freight index here confirms it. This is the Purchasing Managers Index, and for the United States, is, as you can see from here, 2022, like consistent with the previous charts, has been under 50, which in fact well below 50, which means is in contraction. This is definitely not a good trend. It's actually a very negative trend. And by the way, this relates also to the international Purchasing Managers Index. If you look at the Purchasing Managers Index for Europe, is a disaster. If you look at the Purchasing Manager Index of China, has been a disaster for the last 10 years. They are not, the Purchasing Managers Index shows little or no growth, very sluggish growth in China. So you have not only a weakness in the United States, but also you have an overall weakness in the two major areas about Europe and China. So you have really close to 70% of the global economy in deep trouble from a manufacturing standpoint. And this means you have to temper your optimism, basically. That's what really this data is saying. This is a very unique measure of money supply, and is the money supply that is between the money that is flowing between the Fed and the banking system, and is the monetary base. And as you can see, when you have an upswing in the monetary base, then you have improving economic conditions with a lag, and then you also, it leads also the money supply M2 that I showed you before. Now, what this is saying is that now the money existing between the Federal Reserve and the banking system is actually contracting, and this, there is something that is not working right. That's what it's saying. Something is wrong, and it's difficult to pinpoint the main reason, but you have to watch it carefully, because every time you see rising is an expansion. Every time you see a slowdown, there is a slowdown in the economy and in the markets. And now you're beginning to see the same thing beginning in 2023. So this is a strong sign of caution. Well, how are investors behaving? Well, investors are now being very cautious. They're getting nervous. And what this graph is showing is the S&P 500 and the volatility index VIX. And as you can see here, when the volatility is declining, means there is confidence in investors that things are going to be okay, the stock market rises. But when investors become cautious and become nervous and volatility is increasing, you see here from here to here, you see a market that is pausing, and as the volatility index rises, the market declines. Then investors they calm down again and becomes more optimistic. The volatility index declines, and you can see a rise in the stock market. But what you're beginning to see here now is investors are becoming a little more nervous from this point on, and the market is becoming more volatile, meaning that there are a lot of good news, but there are some bad news out there that either the market is overbought or you name it, overvaluation. They're becoming more cautious. So the trend in the volatility index suggests that quite caution. In fact, you're beginning to see that the trend towards rotations from growth-oriented stocks are beginning to see a rotation into more defensive stocks like utilities, staples, and healthcare. So what does all this mean? Well, the economy is strong. That you cannot say that. People who say there is a recession, they've been saying this for 2 years. The economy is strong. It's growing at 3%. There is no way to say the economy is in a recession. The banks are easing lending standards. That's a very positive thing. Means that there is a lot of money around. Inflation is coming down, and this is also very positive because it's improving purchasing power of the consumers. Wages are growing faster than inflation, and the spreads between bonds and the corporate bonds and treasury is lower, meaning that there is no financial risk. So you have growth, liquidity, no financial risk. This is bullish. It's not a bearish environment. Now, what creates the bearish environment is that this is not a broad economic growth. Some narrow areas, some areas are growing, but the important area for me, manufacturing, is in a recession. This is the bottom line. This is because this is where the wealth is being generated, not by spending money on cruises in the Bahamas. The money and wealth is generated by building, and building. And the fact that the commodities are coming down, short-term interest rates are coming down, is all another way of saying the manufacturing is weak. Why? Because manufacturing need less raw materials and need less money for producing goods, the goods that they need to deliver to the marketplace. So this is what makes things the risk of the economy, that the weakness in manufacturing, not only in the United States, but in Europe and China, is going to drag down the economy. Now, this is the risk. It's not a forecast. So what do you do from an investment viewpoint? Well, it depends on your risk profile. If you want to preserve your money, well, you have money market funds that produce close to 5% return with a 2% inflation, so you make 3% in real terms. So that is good. Or you could allocate, and this depends on your risk, some money to investing in stocks. The way I decided to do it in my service in the Peter Dac portfolio is to invest short term, meaning if I see an opportunity for a week, 2 weeks, 3 weeks, I buy, and then when I decide to, if the market tells me to sell, I sell it. The model that I follow has been pretty good. We have the performance on is produced by Schwab, where we have our account, and we have more than 70%, 71, 72% success ratio for the investment, with a 75 gain to 35% loss. So the technique or the strategy works. Now you can use it to put more money than we recommend or less money than we recommend. It is a way to give a little juice to your portfolio. This is the way I have the things. It all depends, again, on your risk profile. Now, we have membership in patreon.com, and we have videos only, or we have videos and financial updates. Every time there is an important economic news, we send an update to our subscribers, or otherwise there is membership number 3, where you get the Peter Dac portfolio is a 22 pages report twice a month, plus economic update, market updates every week, and plus the financial updates. And again, I hope you become a member of our Peter Dac's Business Cycle Academy. And I really want to thank you very, very much for following this video. And I hope you find it very useful. And by the way, if you like it, why don't you subscribe and say that you liked it? Okay, thank you very much. And I'll see you next time. Take care of yourself. Goodbye.